Hi there, traders. This is Brad Gilbert with the FX Market Insight for Friday, the 8th of May. All right, now equity markets aren't really showing any real signs of panic. Pretty much, up 1%. It's just like a normal sort of day. Now, the major pairs, there's a little bit of uniformity across the dollar pairs. Okay, Euro, Sterling, Aussie, Kiwi bouncing, and most of the other pairs going down. The dollar pairs, except for dollar yen, which is just churning sideways, and that's because the market's in a bit of a state of flux. Now, I've been focusing on this all week and talking about it. It's about the rollout of three employment numbers out of the US, right? It always happens on the first week. ADP employment Wednesday, the jobless claims Thursday, and now we've got the non-farm payrolls. There's been a real big build-up of negative sentiment that's been coming through these employment numbers. If I just scroll up a touch here, you'll see the initial jobless numbers. Once again, we're above 22 million for the claims, the continued claims. The jobless claims themselves, just above 3 million, probably just above expectations. The 4-week average is about 4 million, right? So what we've seen, the ADP numbers on Wednesday were minus 20 or 21, around there. And if you come down and have a look towards today's non-farm payrolls, we're looking for numbers, around minus 22. Now, this is where the market gets a little bit weird, right? Because the US dollar goes from being a safe haven in and then out and in and out. It's hard to work out where that direction's coming from because it's all geopolitical. Now, the dollar itself, you can see the dollar index here cruising to the top side, okay, as all the uncertainties about rollbacks of lockdowns, etc., kick in. But what we're seeing now is the impact of continued negative numbers suggesting that the central bank has got to do more. And what they're really talking about is, going to negative rates. And this is really coming back down towards looking at the US bond yields. Now, these are starting to suggest they're just coming down again, suggesting that the central bank's got to do more. And, what, do they keep buying bonds or do they cut rates? Now, this is a bit of a negative for the US dollar. Okay, a bit of a negative for the US economy. And this is probably going to be a flow-on effect. Everyone's talking about, massive global recessions across the board. Well, that's clearly obvious. Now, it gets under my hat or under my collar a little bit when you see situations like the news here. If I can just get my pen up, pandemic sets Japan on course for deep recession. They have been in recession for 30 years, right? So it's like, how much deeper can you get? Just call it a depression. Okay, so this is where it sort of gets a little bit stupid and you're trying to work out where direction's coming from. Well, it gets a bit tricky, right? And this is geopolitics at its extreme. And that's where you see a lot of the pairs. But just bring you over to the pairs here where you can start to see things coming into play now. To me, the catalyst was we started to see some moves higher here after those jobless claims. Now, the ADP numbers on Wednesday already put a bit of a negative spin on, the expectations for the US economy. After that, the jobless claims confirmed it. The non-farm payrolls today will give it another real sort of like shoving it in your face. So what we're seeing is the US dollar sort of roll over, and it's been so clearly obvious that the dollar was rallying that the whole market's been caught out, and we're seeing, massive sort of short squeezes in Aussie, Kiwi, a little bit of a move in the euro, and sterling sort of doing its own thing in lagging. You can see the dollar there, sort of dollar CAD finally catching up with that move in oil, and also that dollar weakness there as well. So the dollar yen really not sort of going too far at this point. So just keep an eye on that as we go forward. Now the euro. Now let me just come back to the daily trade routine. Okay, now what a difference a day makes. If I just bring you across to the daily market insight now, this is how yesterday looked, right? And it's, as I was saying yesterday, like you get it through Wednesday, you get into Thursday's trading, you really get the currency pairs lighting up. And we did have quite a few active pairs. Now, what we're seeing is a complete flip, or not a complete flip, but the overall trend on a lot of these pairs was looking very good, right? Strong dollar, the uncertainty of all the rollbacks of the lockdowns, et cetera, negative US numbers. It was all pointing towards a strong dollar, as in a safe haven play. Now, we had all these pairs, and you had a few pairs on the sidelines. Now, what we've got today, if I just refresh that, right? And you come into today's, the active pairs, the pairs with absolute clear direction, right? To me, there's none, right? Or none of the major pairs, even looking at gold, right? Everything's sort of mid-range. And that's primarily because as we come into today's trading, the non-farm payrolls and the importance of employment, and that's the biggest impact of this whole lockdown situation, right? Is employment and the roll-on effect that will have on retail sales, industry, et cetera, et cetera. It's pretty huge, and that's why the bonds in the States are sort of, if anything, pricing in the potential for negative rates. Now, the sideline pairs, okay, so the watch list pairs, I should say, these are the pairs on the sidelines. You know, they're generally trading sideways. It doesn't mean they don't have momentum. Yeah, some of them do. Like Euro currently sort of up, Sterling up, dollar CAD down, Kiwi up, Aussie up, right? Dollar Swiss and dollar yen just trading sideways. Now we're just going to wait. You've got to wait for these situations, identify this, and then sit back and wait. Let the market beat itself up and then come back when it looks good. Now, overriding all of this, right? Euro, to me, with that fundamental decision from the Germans, Constitutional Court ruling about the bond buying programs or the stimulus programs by the ECB, that's going to keep Euro under pressure. Now, won't stop it popping to 110 on extreme US dollar weakness, but it is going to come back down. Okay, they could be particularly hammered. So if this thing blows up even more, right, well then the Fed's got to come out and sort of work out what they're doing. And this is the sort of stupid part of it is, to me, when that happens, what we'll see is that, yeah, we've got dollar weakness at the moment because they're pricing in negative interest rates. That will be in the market for about a day before they start buying dollars again, because negative rates in the States probably means negative rates everywhere else. And that's a dollar situation where you're buying the dollar as a safe haven once again because the whole globe is slowing down. So don't think these moves here, if I just come back to the charts, are, the start of a big dollar sell-off. I don't see that. I see these as a temporary sort of flush out of positions. What you want to see is we want to see the US non-farm payrolls. Now, if the numbers, let me just bring you back to that data. Now, if the numbers are, more extreme than minus 22 and really focusing on the negative side, so if it's bigger than minus 35, they're probably going to be a certainty of potentially negative rates in the States. Okay, that's going to see, I think, short-term weakness in the dollar, but then that's going to flip around. It might be early next week where, you know what, people will just go, well, this whole situation again is in the too hard basket. Let's buy dollars. It's the natural default safe haven, and that's where the dollar's going to come back. So when you do look at the charts, don't fall in love. I think these things, there's a chance for these things to pop above these resistance lines for sure, right? And that's what the non-farm payrolls data can give it. Enough momentum to blast around. I don't see dollar yen doing too much at this point, but Euro, I think it's going to be a great opportunity to get short. If we see really weak US numbers, negative rates here, they're on the cards. We see Euro spike, market short. We should see a spike up to potentially up to 109.60. That's the spot to be getting short because I think the dollar will be a buy the week after, and that's where we get involved. So at the moment, there's some, if I just delete the drawings here, there's currencies here at trend lines. It doesn't really match up with what I think or what I can see happening. I think what we're going to see is a lot of false breaks leading into the non-farm payrolls. To me, the best thing to do is wait for the data to come out, wait for the non-farm payrolls to come out. Trading the actual release is not only problematic because there's multiple releases to consider, but what you need to think about is what's going to be the raw nerve? Well, employment is the raw nerve, but what we need to consider is, what's that going to mean? Watch the equity markets. If there's a potential, if really weak numbers, equity markets rally, right? That will mean there's bigger potential for negative rates. And that's where we may see the dollar sort of whip about. I think we'll see immediate weakness in the dollar and then it bounces. So whether that's straight after the numbers will depend on the level of variance, right? So I'm covering that sort of side of it. I don't think there's any real chance of these numbers coming out good or better. But look at the range here of all the data. Minus 35 million. The maximum, the good result would be minus 1 million. I can't see that happening with the last two data releases, the ADP employment and the jobless claims, both being minus 20. Okay. It's going to be at least minus 22 or a little bit worse, right? So the answer, where's direction going to come from? It's going to come from this, but it may not come straight away. You've got to wait for the numbers to be filtered in and factored in. As I said, my guess is on these numbers, if it's much worse, initial dollar weakness, we see all these currencies spike, and then they come off as the dollar safe haven trade kicks in again. All right. So there's plenty to consider. And you throw that in. Let me just come back to the news page to finish up. You throw the uncertainty around the dollar and the bonds and potential negative rates in the market at the moment. Don't forget, you've got Trump still throwing barbs at China. You've got him talking about some weird things with regards the coronavirus and what they're going to do. And then, the rest of the market's trying to work out what's going on there. So to me, it's a big day. This is where you see some weird things. I don't think it's going to be a trend potentially, but we're going to see some opportunities, I think, after the numbers, and we have to wait and see how it impacts the equity markets for sure. All right, guys, plenty to take in. Don't forget, have a good look at those. If you haven't already updated your web pages there, I probably would have already been updated. It's interesting to see how these things can sort of turn around from being really good one day to all of a sudden sort of not much, okay, as far as active pairs. And that's really because you can't really see what's happening because the movements are sort of geopolitical. And when that happens, we're starting to look for tangible things like the bonds, what's happening in the bond markets or the general yields themselves. And this is where you want to really fine-tune your trading knowledge and your understanding of the relationship between these instruments, safe havens, interest rate, bonds, equity markets. There's a lot to take in. If you don't understand those things, stand back and let this day roll through. It'll make a lot more sense to you come Monday. All right, guys, have a good weekend. Cheerio.